What's up everybody? Welcome back to the channel. If you're new here, my name is Jay. I love talking about the stock market, personal finance, retiring early, all those types of things, getting out of debt. Anyway, I was able to leave my job after I started getting pretty hardcore about my finances. It took me about 8 or 9 years to get out of a normal job, and now I work for myself. Anyway, I just like sharing my journey, sharing my knowledge. I would like to get a community going here, so if you guys would like to subscribe to the channel, that'd be awesome. Go and smash the like button, leave a comment down below. Today I want to talk about a couple things specifically with dividends. I want to talk about 3 different things that I love about dividends. We'll compare and contrast 2 different dividend paying ETFs, and we'll also bring up a dividend calculator at the end of the video. Now you could also look at individual stocks, but I'll go over some reasons why I think dividend ETFs are a great idea too. So today I want to talk about 3 different reasons that I love dividends. I want to compare and contrast 2 different dividend paying ETFs. And then at the end of the video, we'll go over a dividend calculator. And it's actually really cool. It kind of shows you what you could expect. While I'm specifically going to talk about the dividend ETFs, you could also do this with individual stocks. There are some pros and cons, I think, for each. We'll go over a little bit of those as well. But I hope you guys enjoy the video, and we'll go ahead and get started. Just remember, I'm not a financial advisor. You guys need to do all your own homework. So before we get started, I want to go over a couple key definitions. So what is an ETF? An ETF is a security or basket of stocks that is all combined into kind of one stock. It trades just like one stock. So another way to look at it, it's just like if you bought a stock, but it's actually like 100 little pieces of other stocks that just make into one stock. So the next term is, what is a dividend? A dividend is a payment in stock or cash that a company pays out to their shareholders. So an easy way to think about it, let's use really easy numbers. Let's say a company made $100 at the end of the year and they wanted to give their shareholders $5 a piece, then they could distribute that out to them. So you would just get money just for owning the stock. So 3 reasons I love dividends, specifically ETF paying dividends. Number 1, it's easy. There's no homework needed. You're immediately diversified over 100 to 400, 500 stocks, all in one stock right away. These are all almost always blue chip companies, which means they're well established. You don't typically have to worry as much about their balance sheets. The main thing you need to do is just worry about your discipline and putting money in every week, every month, whatever your strategy is. You just need to keep with your plan to get this to work. The second thing I really like is there's something called dividend reinvestment plan or dividend reinvestment program, depending what brokerage you use. So pretty much dividends get paid every quarter, so every 3 months. Some do every 6 months or every year. Most of them do every quarter though. So whenever you get paid, what happens is the money you get paid just goes right back into buying the stock. Therefore, you start building a snowball. And so at the end of the year, you'll have more shares than you started with just because of the dividend reinvestment plan. And then the next year, it's even bigger than bigger and bigger because you have more money going back into it. We'll use the dividend calculator at the end of this video to kind of look at that point a little bit easier. And the third reason I love dividend companies or ETFs, the S&P companies that pay dividends typically actually outperform the companies that don't pay the dividends when they add the dividend back into the growth. They also could be seen as less volatile. So like this year specifically, the S&P is down currently 24%, while VYM, which is the Vanguard high dividend yield we'll look at, is down 13.9%. So as you guys can see, I have Vanguard High Dividend Yield Index Fund on the left. That's ticker symbol VYM. And we have Schwab US Dividend Equity ETF. That's SCHD on the right. So a couple key points we want to look at here. We'll look at the Vanguard one here first. That's on the left. If you look at yield, it says 3.08. That is the percentage of the stock price that you're going to get in dividends. So for 96.96, you're going to get 3.08 of that every year. And I know you guys are thinking I said that you get paid every 3 months. What happens is that every year you divide that into fourths, and that's how much you know your quarterly distributions will be. Another thing to keep in mind when you're looking at any ETFs or mutual funds is the expense ratio. And that's just basically how much it costs for other people to manage this for you. Even if you have your own brokerage, you pay some fees. But just know it's 0.06, that's for both of them, that's dirt cheap. So you can see here on the right, the Schwab ETF, the yield is 3.35, so just a little bit higher than the Vanguard one. And just know the price of the stock has nothing to do with the quality of the stock or the ETF. So we'll go ahead and look at these a little deeper. We'll look at some holdings and their dividend growths here. To keep this easy, I've kept the Vanguard ETF on the left and the Schwab on the right. The only thing I want to look at here, if you see the dividend history, that's kind of in the middle of the page here. You can see they are slowly, steadily going up from the left to the right. They're going upwards trend in both of them. That's just showing that they're growing their dividends as they go. So here's another good page to kind of show the difference between these dividend ETFs. So you can see Vanguard here I kept on the left and the Schwab on the right. You can see these beautiful pie charts up here. They're just showing the difference in the holdings of like financials, healthcare, consumer defensive, industrials, those types of things. Anyway, you guys can look at that a little bit closer if you want. Under the top 10 holdings on the very bottom, if you look at number of holdings, so VYM on the left, if you see where it says 446, that is right here. If you see that, that's how many shares are inside that one stock that you buy, that one ETF share. So 446 in the VYM, and on this one you have 104 on the Schwab. So the VYM is actually, you could potentially say it's more diversified. There's more shares inside of that one stock. And the Charles Schwab one will be a little bit more concentrated on 104 shares, or 104 different companies rather than 446. Another good thing to look at here is the top 10 holdings. So you can actually look at the actual holdings and judge them based on that. So like Johnson & Johnson, Exxon, JP Morgan are kind of the top three on the VYM. Merck & Co., Pfizer, and PepsiCo are the top three on the Schwab. But more importantly to me personally, if you go down to total here, where it says 22.56, that's the total weight of the top 10 stocks. So 10 of those stocks make up 22.56%. So that means roughly the 436 other holdings that are in this share, I'm talking about the VYM, the 436 shares make up the other 78% of the weight. That's compared to the Schwab one that has 104 shares and the weight is 40.3. So that means the other 94 have about 60% of the weight. So what we're getting at is the Schwab top 10, the weight is way more important. So therefore, if those top 10 companies have more trouble, that just makes more weight of the portfolio. So those top 10 companies are more important in that one than they are in the VYM. I'm not saying they're not important in VYM, but they just carry much less weight. So a cool strategy to think about if you don't want to invest in just one of the ETFs, like 100% in VYM or 100% in SCHD, you could do 50% in each one. That would be like, let's say you had a $1,000 portfolio, you could put $500 in Vanguard, $500 in SCHD, and then that way you have both, so you're exposed to both things, so you don't have to necessarily like one strategy better than the other. You can take advantage of both of them. So I found this awesome calculator online. This is from MarketBeat. It's actually a dividend calculator. So you can actually put in, it says choose a stock to populate the dividend data. So you literally type in the ticker symbol and it brings up all this information for you already. So we're gonna go through a couple of things here. So it's an individual stock. I'm gonna say we do quarterly because that's how often the dividend pays. DRIP, yes, that's the dividend reinvestment program. That means that every 3 months the money is gonna go back into the fund and buy more shares. We're gonna start with, let's start with 10 shares. This is the current price. We're gonna put in just $100 a week to start, which is $5,200. $5,200 a year, so $100 times 52 is $5,200. The dividend tax rate, which is actually cheaper than like what you would make at a job, is 15%. The annual dividend yield right now there is 3.25. This is saying the annual dividend amount increase is gonna be 3%. And this is the annual share price is going to go up by 3%, which actually historically it's been higher than that, but we'll go ahead and go with that. And let's go with a 30-year horizon. And we'll click calculate. So you can see after we click calculate, we have total dollars on the left, and then the right side shows what it's actually doing. So the portfolio balance. So after year one, we have $6,225. That is because we started with 10 shares, so that's roughly $1,000, and then we contributed $5,200. So now you have $6,225 to end this first year, and we're gonna go to 15 years and 30 years. So after 15 years, you have $121,000, and after 30 years, you'll have $402,000. That's just from doing this dividend with the $100 a week. So dividend income, this is how much the holdings you have is gonna pay you. So you can see the first year you made $31.51. Year 15 though, you've made $3,500 that year. And then year 30, you made $12,186. So just to explain real quick the yield on cost, let's say you bought a $100 stock and it was paying a 3% dividend. You're getting 3% of $100, which is $3. And let's say in 10 years from now, you still own that share. In 10 years from now, the stock is worth, let's say $150. It still pays a 3% dividend. So now that's paying $4.50, but you bought it at $100. So that original one you bought is now yielding at 4.5%. Leave a comment down below if that's confusing anybody. I try to make that as clear as I could. Anyway, year one is 3.29. year 15, 4.9, and year 30, you have an 8.13% yield on cost. So that means all these shares you bought in the first year, you're now making an 8% dividend on those first shares, as well as you were buying on the way up. So this real quick is the bottom of the dividend tier. I'm going to do one more example with putting in $200 a week. We'll see what the difference is. So shares owned, you can see you start getting fractional shares because it's buying as much of the shares it can with the price that it has. So after you do this for about 15 years, it starts getting pretty exciting. You can see it's worth $120,000, and then at year 20, $190,000, 25 is $281,000. So you can see from year 20 to year 30, it actually doubled. So it's really cool. That's what's nice about getting behind compound interest. Get that on your side. So now we have $200 a week in there. Let's see what that does. All right, so we'll run through the numbers real fast here. You can see total dollars. You start with $11,425 this time because you're putting in $200 a week. Then you go to $240,000, and you end actually at $800,000. You can remember last time with the $100 a week, you actually had $401,000. And the dividend income, you started with $31.51 per year. Then you had $7,000 the 15th year, and then year 30, you actually made almost $24,000 just from dividends that year. And yield on cost, which is like the snowball of the snowball effect here. So you had 3.29, then 4.88, and then you ended up with 8.1% of your dividends. That is a percent of your dividend now on this fund. So I hope that was helpful. I hope you guys understand a little bit more about dividends here. And like I said, I'm not hating on people that buy individual stocks and make their own little ETF or their own little portfolio of dividends here. This is just the easiest way to do it. You get exposure immediately. I'm not a financial advisor, but this is just such a simple thing to do. So I hope you guys got a lot of value out of this video. I hope you understand dividends a little bit better and just the cost and the snowball effect of the dividends. I hope that this is, like I said, maybe has gotten somebody interested in it. If you guys have any questions about this, please leave it down in the comments. I always look through all the comments. Please subscribe to the channel, join our community, smash the like button. Let's end this video with a picture of Pongo. Like I said, thanks for joining me today. I hope you guys subscribe to the channel. I hope you learned something. Smash the like button. Leave a comment down below if you guys think Pongo's cute or anything else about dividends we learned today. This is him just hanging out in his bed. He's actually waiting for a treat. And this is inside my house with like a little studio lighting and stuff. So anyway, I'll talk to you guys later. Hope you guys are having a great day.